Hey, good morning, everybody in Leaving California world. Are you thinking about leaving California? Are you thinking about buying or selling a house? You came to the right place. This is Money Matters, episode 20, and we're here to give you all the information. And there's some facts that you really need to know about. So thanks for tuning in. Good morning, Terry. How are you?
I'm doing great, David. I'm curious to hear from Monty this morning what that rate cut by the Fed did for us last week, what effect it has on the housing market and mortgage rates as a whole.
Well, Terry, you're right. We are so blessed and so lucky to have one of the top 1% lenders nationwide that's licensed in all 50 states. He can help people leave California and go basically to any state. So thank goodness we got Monty here to clarify some things. Monty, how are you? Let's get right into it. What's going on?
Doing good. Phone has been ringing a lot with people excited about what the Fed did last week. They started their rate cutting cycle with an aggressive move. We were debating 25 basis points, 50 basis points, and boy, they went for that 50 basis points. So that new easing cycle has begun, and that's exciting. I'm kind of describing it as the Titanic being turned around. They cut the benchmark Fed funds rate by 50 basis points. They did not cut mortgage interest rates by 50 basis points. That's been the biggest conversation and the hardest, most disappointing conversation that I've had to have over the past week is rates did not go down. Actually, the Fed funds rate got cut to 4.875, but remember, that's the rate at which banks can borrow money overnight. That is not mortgage interest rates. Interest rates actually went up. Today, we're up 16 basis points after going up last Thursday and Friday. So it's actually getting worse in terms of the mortgage interest rates, but so minimally that I would tell you don't let that make your decision. The media is going to sell this as negative, bad things. It's not bad things. It's good overall. That cut signals the start of their rate cutting cycle. So this decision was not unanimous, however. Federal government Michelle Bowman, she did want 25 basis points. So she was a dissenting member there saying she did not want to cut 50 basis points like they ended up doing. The Fed began aggressively hiking that funds rate back in March of 2022. They were trying to slow the economy. They were trying to curb that runaway inflation that became rampant after the pandemic. More recently, the cooling consumer inflation, the rising unemployment rates, that's caused the Fed to acknowledge that the time has come for policy to adjust. They finally acknowledge we got to do that. So the Fed's trying to ease the interest rates to keep the economy from entering a recession. So as much as rates haven't dropped yet, that is where they're going. These are connected. They're not the same thing, but they are connected. So they're currently forecasting another 0.5% cut by the end of the year. So another 50 basis point cut by the end of the year, an additional 1% cut in 2025. However, these forecasts can change in either direction as economic data presents itself. So in addition, it's important to remember that the mortgage interest rates are not going to directly follow that Fed funds rate. They're not going to move in similar increments necessarily, but if the overall interest rate environment is moving lower, that's typically a good sign for mortgage interest rates. They do tend to follow that overall curve when you watch that. So probably beat a dead horse there, but I wanted to make it really clear to our members. Still a great time to buy. It's even better than it was a month ago. However, it doesn't mean that the bottom just dropped out and we saw rates go from mid sixes to mid fives or anything like that. That is not the case. And you should be grateful that that didn't happen, I would say, because if that did happen, that's instability. That's where Terry talks about stagflation. Things happen that are bad when drastic moves are made. So yeah.
Yeah, it's very interesting, and that's a great explanation. We always want you to give more, so don't feel bad about that. Was a good way to explain it. And for those of you that didn't get to watch last week's show, Monty talked about something that is so important because you can't just stay laser focused on the rates. You have to think about the appreciation of a home that you're going to purchase. And for those of you that didn't watch last week, can you recap what you talked about last week on appreciation, just so people understand not to just solely focus on interest rates?
Yeah. So we were saying how it's so hard to ask as a home buyer anything other than what's the rate I have to pay and what's my monthly payment. Those tend to be the only two things that home buyers know to ask about or consider. What we want to do is go further and teach you more about how to be financially wise, how to build wealth, things that you're not being taught. And so the biggest lesson I think you can learn is appreciation will dwarf that interest rate. Remember, interest rates, when you pay that interest every month, that is tax deductible. So last night I was going through with first-time home buyers and explaining to them they were buying a $370,000 house and they were going to pay $493,000 in interest over the 30 years of that loan. So they were going to end up paying nearly $900,000 for that $370,000 house. And as much as that's shocking, I was telling them, think about this though. All of that $493,000 is going to be tax deductible interest. So that's going to actually help you write things off, be able to take that money not as wasted, but as good. The other thing that you've got to realize is in those 30 years at 5% appreciation over time, that house is going to be worth a lot more money. And so, yes, you spent $900,000 on it, maybe, but $500,000 of that was really tax deductible interest. The appreciation on that home, I can run that up in a minute. I didn't do that for them, but just think about this. Let's do it on a short term for people leaving California and thinking they're going to go somewhere, even in the next 3 to 5 years. What we said last week was homes are expected to appreciate across the nation, on average, 20% in the next 5 years. So that's really good. And that doesn't mean that it's always going to be 20%. In certain markets, it's going to be way higher. And most of the markets we're talking about, those are going to be higher than 20%. I'd say in Dallas, Texas, it's going to be closer to 30%. If you look at how many people are coming and how fast homes are going up in value. Same thing in Knoxville, Tennessee. Same thing in Nashville. Same thing in Myrtle Beach. Same thing in Charlotte. All these cities we're focused on, they're going up really quickly in value. So it's a great investment. So if you look at that, if you buy a house at $500,000 right now, it's going to go up about 20%. So that's $100,000 in the next 5 years. So you made $100,000 by making that move just from appreciation alone.
I think you forgot Southern Nevada.
Forgot about it. Yes, sorry. Las Vegas is the best of all the places.
I'm a little partial to Florida myself.
Oh, there you go.
Yeah, Terry, it looks like you got something you want to ask. Go ahead, Terry.
Yeah, I just want to remind people that because interest rates went up last weekend doesn't mean that's the interest rate you're going to pay when you buy a house. Interest rates change for mortgage. Correct. Interest rates change every day, all day. They certainly did when I was in the business. I'm sure they do now. And let's remember, if you're 6 months away from buying a house, go ahead and start that process now of getting approved, starting to think about when you're going to sell your house, where you're going to buy, things like that. So you've got your ducks in a row. So when it comes time to lock that interest rate in, you can lock it in at a rate that you're comfortable with. And let's face it, rates keep dropping. Just refi the thing. That's a great way. You're not losing out on appreciation that you would have when you buy that house sooner rather than later. I'm telling you, people are going to move to the South. You think things are growing in the South now? Just wait until this next presidential election. I think we're going to have some very, I don't want to use the word chaotic because that might get me banned, but I think we're going to have some real controversy going on after the presidential election. And people are like, you know what? It's already crazy enough in California. It's crazy enough in all these blue states. We're getting the heck out of here and moving to a red state. And what does that mean? If everybody's moving to red states, that means much faster appreciation, as Monty was just alluding to. Why not come to a place where you pay no state income tax? Tennessee, incredibly low property taxes, incredibly low homeowners insurance. I'm telling you, people are going to find this out and they're going to start moving. And you don't want to miss that appreciation boat, a place that you want, that is very desirable for you to live, and then you get priced out because so many people have figured it out and they've already moved. So don't wait. Call Monty as soon as possible, even if you're years away. Start the process now of having a plan in place so you can get that move done. It's stressful enough to move, let alone if you don't have a plan in place, and Monty can help you with that plan.
That's great advice. And for those of you, the guys that have been watching our show for the last 6 months, you know who Terry is, but Terry Gilliam is our founder of Leaving California. We have 300,000 members, getting close. And that is great advice. Thank you, Terry. What else do you got for us today, Monty?
Well, the existing home sales actually came in weaker. We got that report too, kind of dwarfed by the fact that the Fed funds rate was cut by 50 basis points, but it still really matters, especially to our members of Leaving California. The number of closings declined in August. Some of those internal reports, though, they point to a lot of demand. So even though closings look like they're down, there's a lot of demand, and there's really not enough homes. The inventory is not even as much as it was pre-pandemic. So we've got more people now. We've got them out looking for homes. There's pent-up demand, but the houses are not there for it. So in a way, you should be grateful that if you are looking to make that move, you can do that before the rest of the world is looking to do that. These rates are going down, but they haven't yet hit the lowest points. And so I would say sooner rather than later, you're going to get a way better deal if you can do that sooner. So the homes remain on the market on average. This report said about 26 days in August. About a quarter of those homes sold over the list price. So don't necessarily think you're going to get a steal of a deal and only move if you get a house way under what they're listing it for. There's still a quarter of those homes that are selling over that price. We expect these lower interest rates coming up to spur more demand. And so for more people to hit the market, we are seeing inventory at about 1.35 million homes available for sale at the end of August, but that's over the whole nation. You got to think about, we've got 350 million people in America and only 1.35 million homes are out there. So that pent up demand for homes combined with the ongoing tight supply is going to continue to really show people that homes are a great investment. That is a way to build wealth. It really is good. And home appreciation that we talked about, that's going to only help you get further ahead in life by doing that.
Well, Monty, you said the term beat a dead horse, and I talk
Yeah.
about this, and I've been talking about this on our show every week. And maybe I'm passionate because I did write this book, Freedom from Rent, Stop Paying Your Landlord's Mortgage. But honestly, and by the way, if you guys want a copy of my book, I can send it to you. So make sure you message me. I would love to send you a copy of this book. Gives great information. But not most, I would say a lot of our members, they really think that when they leave California, they go to their new place and they should rent. And I basically say, if you're going to be there for at least 2 years, with the way the appreciation is going, I think it's a better idea to look at buying. Can you talk? I don't want to beat a dead horse, but can you talk a little bit about the people and their thought process of, I'm going to go to this new city and I think I'm going to rent? What do you tell your clients when they have that mentality? And what kind of advice would you give to someone that's thinking that way?
If at all possible, definitely buy, because you're going to catch that wave of appreciation. Think about that. It doesn't take very long for that to pay off. I ran the numbers while y'all were talking a minute ago. That $370,000 home 30 years from now is going to be worth over $1 million, significantly over $1 million. So that's what we mean on a smaller scale. Even if you only bought that home and kept it for 2 years, let's say it went up 10% in value in 2 years, that's way better off. You had 2 years of interest that was tax deductible, plus you didn't pay your landlord's rent, as David's saying here. So overall, you're going to come out ahead. Even if you're paying closing costs, I can show you both sides of that. You're still going to come out ahead by doing it. So if at all possible, it's not for every single person, but yes, it will be way better to buy if you can do that now. Certainly in this season, yeah, that would be a really good thing.
Thank you so much for that advice. I appreciate that. And, we're going to be wrapping up our episode 20 today of Money Matters, because it does. Terry, what else do you got for us this morning?
Again, I just stick with have a plan. You want to talk to somebody like Monty. You want to talk to Monty. Monty's, again, he's licensed in all 50 states. He can help you anywhere in the country to figure out what's a great time to sell, great time to buy a new home outside of California or another place that you want to leave. The other thing to remember is that what I'm seeing, because of the increase in home insurance rates in California, fewer people can qualify because you have to qualify what's called PITI, principal, interest, taxes, and insurance. Now think about it. Most homes in California, a lot of homes are $1 million or more. Your property taxes alone are over $1,000 a month. Now homeowners insurance is what, $3,000, $4,000, $5,000 a year? You've got to qualify on that payment with your income. What I'm seeing is that as all of this goes up, and California will never lower taxes, so that's going to go up. You're going to see that houses sit on the market longer because fewer people can qualify. But as Monty was saying, we're getting a lot of multiple offers here in the South. Homes are selling quickly. Now, again, it depends on where you go, and it's not always. We know that. But just don't think that, hey, a year from now, my house in California will be worth 10% more, because as people leave these states, somebody's got to buy these houses. So don't be afraid to, if you're looking to leave, don't be afraid to start that process now.
Mm.
And Monty, anything in closing for
Good
today's show?
point. Yeah. I wanted to remind everybody unemployment's the other thing we're always watching. And so we did see that those continuing claims for unemployment is still over 1.8 million people for 15 straight weeks. That's near the highest since November of 2021. So 3 years we've been there. Those continuing claims have gone down a little bit over the past few weeks, just a few thousand, but that likely encompasses benefits expiring, as well as some people finding a few new jobs. That hiring rate's 3.5% right now. That's near the lowest level since 2013, not including COVID. So we're in a place where you've got to take care of yourself and your family. You got to leave and do what's best for you. You got to stick with the job that's going to work. Move to one of those places. There are jobs in those places. The realtor network that we have, these people are deeply connected in the community. We're not just here to help you find a house. We're here to help you find a life, a job, a church, whatever you need. That's what we're going to do. We're going to exceed your expectations. So please do reach out. On the interest rates, just again, remember, we've got to watch over time. We're going to see it go down. We predict from what we're hearing from the Fed that they'll do a 25 basis point rate cut November the 7th and another 25 basis point rate cut December the 18th. So we do believe there's two more this year, both 25 basis points. As those come and we see the likelihood of that happening closer to that time, you're going to see those rates continue to go down because the same as the 50 basis points was priced into the market, we will go ahead and price in the 25 and the 25 as we get closer. So buy now, leave now. I promise you'll thank us later. You'll write Terry and David a Christmas card and tell them, you know how much money you made me. Thank you. Thank you.
Well, thank you. That's such great advice, Monty. And I want to thank all of our watchers and listeners of our show. Our show's growing like crazy, so we appreciate you guys commenting, liking, subscribing, and sharing our content because we know there's a lot of people. And as Terry Gilliam says, there's going to be a lot of people leaving after the election. Hope you guys are having have a great week, and we will talk to you soon. Take care. Bye-bye.